Hey everyone! This is the sixth lesson of Ethan Trade Stocks. Today, we will learn the basics of day trading. A quick disclaimer. When day trading, it is a given that you may lose money at some point. And please do not be discouraged and try to break even on a stock simulator until you get the hang of it. In day trading, we only buy companies because they are driven by volume. This volume is attracted by news or innovation. However, if there's no relative volume behind a company, we do not buy it, even if it has the best financials or innovative ideas. A candlestick chart is a staple of day trading, and a candle represents the price of a stock over a certain period of time. Typically, people look at the 1 and 5 minute candles. As you can see, there's a green and a red candle. The green candle signifies the stock price moving up, whereas the red candle signifies a downward trend. You can see there's two parts to a candle. The wick, which are these stick-like shapes protruding from the middle, and the body, which is this filled-in, colorful, rectangular shape. You have the open, which is at the bottom of the body, the close at the top. This is switched on the red candle, whereas the open is at the top of the body and the close at the bottom. For both, the low is at the bottom wick, the high at the top. These represent the fluctuation. Looking at candlestick chart patterns and volume helps a day trader predict stock price movement, which is very helpful. This is an example of a candlestick chart, fully completed. You can see the red candles, you can see the green candles, and there's patterns between them. More on that later. Types of candles. There are different types, one of which is the Doji Candle. It has a small body and a long wick. This represents indecision in the market through the fluctuation of its wicks. The bottoming and topping tailed candles. A bottoming tail signifies an upward trend, and it doesn't really matter the color. Whereas a topping tail over here signifies a downward trend. Long body candles have a long body in proportion to their very small wicks. Never buy a stock after a green long body candle because you're buying it at the high. The price just moved up. You missed the opportunity. But after a few, which is around 2 to 4 red long body candles, the price usually bounces back up after it dipped down, which is a perfect place to enter because you're buying low and selling high. Types of pattern strategies. The first of which is the hammer. You can see the circled bottoming tailed candle, signifying a reversal after this downward trend. You can see the stock price is going down. You see the bottoming tailed candle, and the price jumps right back up. The three-line strike. If, after 3 red candles, the fourth candle opens lower and surpasses the previous candle's wick, which is right around here, then that is the perfect place to enter a trade. The price has just come down, so you're not buying it at the high, and since other people know about this strategy, they will be entering at the same spot as you, meaning that the volume is increasing, ergo, the price will increase. The gap and go strategy. Before the open of the stock market, look for a stock on your stock screener that has a low float and high relative volume. Once the market opens, buy that stock and let the volume drive the price way up. Since only the demand is increasing and not the supply, the price will increase. After some time, around 15 to 30 minutes, you can sell that stock for a profit. Stock halts. The volatility halt, otherwise known as a circuit breaker halt, are caused by a stock rising or falling more than 10% in a 5-minute period. The stock price is locked in place for 5 to 10 minutes. This allows the stock's volatility to decrease and be less sporadic, hence the name volatility halt. Whatever direction the stock was moving before the halt, it'll usually pop in that direction after stop. Say a stock was moving up really fast, up to $5, and they got stopped. After the halt, it could jump up to $5.50 or even $6. Government investigation halts. This only occurs in penny stocks, so stocks under $1. It happens when the government investigates a company that may be trying to manipulate the market. Be warned when buying penny stocks, because they could be halted for months on end, and you will not be able to exit the trade because no one's going to buy the stock from you. Tips for day trading and mitigating losses. The 2-to-1 profit to loss ratio. Before entering a trade, always assess your potential profit and losses. You should be able to make at least twice as much as you could lose. Additionally, you should make an enter and exit price for yourself so that emotions do not get in the way of your trade. For example, I will buy a stock at $5, sell for a profit at $6, or sell for a loss at $4.50. In doing this, I did the 2-to-1 profit to loss ratio, and I made it so that emotions would not get in the way of the trade by making mandatory places where I have to buy and sell. Fading out is a classic strategy in which a trader sells a portion of their shares once they have made a profit and holds on to the rest in hopes of making an even higher profit on the remaining shares. If suddenly the price drops and you sell the remaining stocks for a loss, you would have at least broken even because you cashed out on a portion of your stocks earlier. Margin, otherwise known as leverage or buying power. It is money you borrowed from your broker. Usually the broker gives you 3 to 6 times as much money you have in the account. So if you have $100 in the account, they could give you anywhere to $300 to $600 in margin, which is a lot of money. Be careful when using margin, because even though your profits can increase, you could lose big time and go in serious debt. So in short, never use margin because of the possibility for massive losses. Thank you so much for watching this video. I really enjoyed making it, and thank you so much for all the support on YouTube. I really hope I could see you in the next one. Bye.